Yeah, also guys, welcome to another YouTube video. In this video, we are going to be breaking down a simple scalping and day trading system you can use on silver. Now, I trade silver, gold, and BTC, of course. Now, in this video, I'm going to show you a trade that I took this week. I took just one trade, and that was on Tuesday. Then I'm actually expecting another one. So basically, first of all, I want to give you a structure of what this setup normally looks like. Now, I have been trading more of gold lately, this season actually, because of the choppy sideways market. Now, I actually make more money trading um, gold when the market is choppy because it gives a lot of 5 minute structure, 15 minute structure. All right, let me just show you that. As you can see, this kind of market, I make more money trading gold in this kind of market because it gives you a lot of structure to take buys and sell from. All right, unlike the normal displacements that you see on the market where we just see gold and silver, keep pumping. So in this video, I'm going to show you the system I use for silver actually. And at the end of this video, I'm going to tell you at what time exactly silver normally gives setup or normally moves so that you know when to expect high probability setups, because you can see setup at any time on the chart, but when if you're able to identify kill zones or peak periods when the market is most likely to give you a very strong setup, then you have an edge. So first of all, let's look at the sketch of this particular trading strategy. So this might actually be, you know, um, termed or coined as smart money style of trading, right? Where we have the breakout structure, then we're going to have some kind of inducement over here. Then we see price coming down. Take out that inducement, then we'll now go down to the smaller time frame, all right, and look for an entry, then also target this liquidity over here. So what we'll normally see in this kind of structure is that first we'll have to identify our breakout structure. Now at the end of this, I'm also going to show you a trade I'm expecting in the coming days. This same week, today is already Thursday, so the setup might form maybe today or tomorrow, or land on by Monday, depending on when you're watching this video though. So first of all, you want to identify the break structure. Now this is in a bullish market, right? So once you identify your breakout structure, you want to also identify the foundation that leads to that breakout structure. So in this case, this is going to be our foundation. Now you can term this demand zone in terms of a bullish scenario, or supply zone in terms of a bearish scenario. Now this is a bullish scenario, so we're going to coin this a demand zone or the foundation of the structure or other block or whatever you want to call it. I don't really care the name. The whole trading system is still the same thing. Now in this, once you identified your breakout structure, now you identified the foundation of that led to that breakout structure where you have your order block. Now another thing you also have to identify there is your fair value gap. Now there needs to be, for this particular foundation to be a valid foundation where you are expecting price to retrace to, right? There needs to be presence of fair value just after the order block. All right, so you should have fair value gap over here. Now, this is where most people get it wrong when looking for fair value gaps. Now, the type of fair value gaps you look for here depend on the time frame of this particular structure. Let me give you an example. In this particular market right now, right, in this market over here, since this is 15 minutes time frame, I want to see price give me a 15-minute fair value gap in this area. All right, that 15-minute fair value gap is what I'm focusing on. That is what is going to validate that this order over here, this order block over here, or this zone over here is a valid foundation of the structure. So in a case whereby there's a 15-minute structure, you're looking at a 15-minute setup and you are seeing like 3 minutes fair value gap or 1 minute fair value gap, you might not really want to rely on that foundation. You need to see 15 minutes fair value gap on a 15-minute structure. You need to see a 1 hour fair value gap on a 1 hour structure. You don't mix it. If you are sticking to with the 1 hour structure, You stick with 1 hour fair value gap. You're sticking with 15-minute setup or structure, you stick with 15-minute fair value gap. That is how this whole thing works. All right. So the fair value gap here, you want to identify, you want to make sure that there's a 15-minute fair value gap. Once you have identified that, you now identify liquidity or engineer liquidity or external liquidity or structural liquidity, whatever you want to call it. Liquidity is liquidity, or manipulation or inducement. You can call it anything you want to call it. So inducement or external liquidity, they are all the same thing. So what they actually stand for is this moves over here, this particular move over here. All right, see this movement over here and also this movement over here. So what actually happened in the market was that after price broke structure over here, it came down. Now it tricked buyers to think that okay, the market is about to pump back up. All right, so we saw this move over here, but it did not go to create a new high. Price still came down. All right, trick sellers too that the market wants to sell and people will start selling, the market will come down over here. Then trick them again that the market wants to start going up, and to go up, as you can see, it will not create a new high. Then eventually price will now come down to clear out those liquidity. That's the stop loss of those who have been buying the market in this area. Then it will now go down and tap into this fair value gap. Now, one thing that you must understand about this strategy is that price will always come down to tap this fair value gap, even if it does not go down to the foundation. The foundation mostly is for you to identify where to place your stop loss, that you are most likely going to be safe in that particular trade. It's not every time that the market is going to come down to this other block, this foundation or this demand. Sometimes it's just going to come to this area and give you a setup. After tapping into this fair value gap, then it starts going up. That is where the golden zone strategy that I use comes in, because once price gets into my golden zone, I start looking for setup. Now the funny thing, and also one fact about gold, silver and BTC, is that once they are in that golden zone, all right, the golden zone is like a Fibonacci level. Now once they're in that golden zone, if you're using the 15-minute structure, for example, they will not give you setup until the market is ready to go back up. That is one unique thing about BTC, gold, and silver that I've noticed so far. I don't know about other pairs, but that is what I've noticed. But I believe pairs like Euro USD, major currency pair, they also do this. So once they get into that golden zone, they only give you setups when the market is ready to pump back up. So that is what this liquidity is all about. So liquidity is inducement. And I also made a video about inducements, which you can also watch, that will pop up over here. Now, the next thing you also want to look out for is your after you've seen the liquidity sweep, right, which is this movement down here that took out this liquidity. So these are liquidities over here. This movement over here, people will put their stop loss there. Then this other movement, people put their stop loss. These are the two liquidities over here. Now, most times, how to identify if any movements or two set of movements are actually liquidity is that you will have what we call relative equal lows. Now, this is like I said, this is a bullish scenario, right? In a bearish scenario, you call it relative equal highs. Now, it will create relative equal lows. Now, what that normally does, or how to identify that on the chart, is that this second movement here most times does not take out this one. So it will not be that equal, relative equal lows. So it is this particular movement over here now, all right, this movement over here now, that movement that will now take out this liquidity here alongside this liquidity here. That's when price will now come down to this fair value gap, give you a setup, or tap into golden zone, give you a setup, or tap into this other block and demand zone and give you a setup. So now the next thing, which is the final thing to also look out for, is your entry. What does your entry look at? Now that is when you now go down to the 5-minute time frame, right? Because this is a 15-minute time frame, 1 minute or 5 minutes, whichever that you are comfortable with. Then you now look for a change of character. So what I'm expecting to see here, all right, what I'm expecting to see inside this area over here for me to buy, right, since the bullish scenarios, I want to see price come down on the 15-minute time frame or 1 minute time frame. Now this movement is the one that is going to tap into the FEG. Now one thing to also take note about this strategy, or one mistake most people make, is that once price starts to the FEG, they go all in. No. What I normally do is that I set 50% limit order at this FEG, because what price does most times is that it will tap the FEG, then it will go back up, right? It will go back up, then it will now come back again to take out the liquidity in case you bought from that FEG tap and place a stop loss. If it take you out, then it will now come back and give you a change of character. Now, once it's giving again, once it gives you this change of character, as it gives you this change of character over here, then you can either take your entry, right, at that very candle that gave you that change of character. Then your target is going to be this high over here, or depending on the market condition, or how, if it's a very strong bullish market, you can just enter. But if the market is a little bit slow, all right, you can wait for a retracement of that change of character, then you can take your trade from this particular level over here. Most times what I'll do if the market is choppy is that once it breaks, just measure. What I'm giving you now is full tutorial, all right, full lecture. What I will do, mostly, as you can see, I have my tools over here, is measure this move that gave me that change of character on the 5-minute time frame, or my entry time frame, whatever, whether it's swing trading or day trading. Measure 50%, then set your limit order. Measure 50%. Now remember, I am talking about what happens inside here for you to know, identify an entry. Now measure 50% of that change of character, then this now will you now target this level. Now this placing of stop loss is where it now becomes more of your own choice, right? Depending on the market condition or how much I want to risk, I will decide to either place stop loss just below this low, which is going to be the low of that 5-minute change of character here, or I decide to extend it down to this area. So I might either have something like this. So let's say this is where I got the setup. Now we either end up having something like this, right? Have something like this. Just take this out. So I either have something like this, which is a tighter stop loss, better, higher risk to reward trade, or I will now have something, or I will have something like this. Now this one is more relaxed and more comfortable, all right, but it tends to either give you low risk to reward, or you're going to be risking more than you should if you still want to make the same amount hadn't been you place your stop loss here. So this is basically the structure of this particular strategy. Now let's take a look at the trade that I took. Guys, if you love this tutorial, let me know in the comment section. I've not really posted videos lately because I'm on monk mode, just improving my trading personally. So I just want to dish this out because learning continues. It also helps me as well to be in touch with my skill. So now let's take a look at the trade that I took. I don't have the screenshot to share here, but let me just identify trades. That was on Tuesday, I think. So on Tuesday we had this particular demand zone over here, right? Then we had this breakout structure. Now watch what happened here. This is the 15-minute time frame. So on the 15-minute time frame, we had this move over here, had this high, had this low, then we have this massive move over here, gave us breakout structure. Then we saw price coming down. Now this is where it gets tricky. How do you now identify the external liquidity here? Remember I told you that to identify the external liquidity, right? Now how I did that was going down to a smaller time frame. And if you go down to a smaller time frame, let's see what price did there. This was the demand zone where the entire move started. This is the breakout structure. Here's the breakout structure. Okay, so this is breakout structure. So as you can see, what price did that when price created this high and gave that breakout structure, it came down the first time. Then it started buying. People will be tricked to say that, oh, since price has retraced and is bullish, let's start buying. What did the market do? It did not go to create a new high. It just came to this point, then came down to the stop loss over here. Now, what happened? You see, price tapped into this fair value gap. Now, remember I told you that Price will first of all tap into fair value gap. Sometimes it will push up like it wants to go, but it will later come down again to take you out. In case you entered because of this fair value gap, then it will now create a change of character, then continue to the upside. That's exactly what happened in this area. So the external liquidity here, you can identify it on the 5 minute time frame, is going to be this. Now, sometimes it might be just one move, sometimes it's going to be twice, giving equal lows, depending on the speed of the market. If the market is strongly bullish, it might just be once. If it's not that strongly bullish, right, and it's a smaller time frame like 15 minute time frame, you're just going to see one external liquidity here, or one inducement over here, or a single inducement, as the case may be. So as you can see, once price took out these inducements, tapped into this FEG, went back up again and retraced back. Now, another way to know if price is going to instantly respect this FEG, or if price is going to go down. If you have an FEG that was not closed before price came down, tap this FEG, then price is going to go reject from that FEG, then come down. But if this entire row over here has no FEG and price is coming to an FEG, just take your trade from this area. Then you can decide to either maybe put your stop loss with a little bit gap here, or just place it below the entire demand zone over here. So in this case now, as you can see, if we go down, like I told you guys, if the market is aggressively bullish, you don't wait for retracement. So as you can see, when price came down, as you can see, this is a change of character over here. It's a change of character, right? Now, this strategy, you use it for gold, you use it for silver, you use it for BTC. It works perfectly for gold, works perfectly for silver, all right? So I might even title this video gold scalping or day trading strategy, because it works perfectly for both of them. Now, this is our change of character over here, right, on the 5 minute time frame. Now, the reason I said that I don't normally wait for that retracement, or I just put 50%. If you look at this area, you can see that this is where the breakout change of character occurred. So if you're waiting for retracement, you would have missed out of this trade. So once you enter this trade here, like I said, there are two ways you can run your two places you can put your stop loss. You either put it below this level and target this high over here, which in this case now will be a 1 to 6 risk reward. Now that doesn't mean that you can't target higher if you choose, but I'm just using this as a reference on the strategy. So using this area, you see that your risk reward here is 0.6. Now if you are to put your stop loss here, you can see that risk to reward is not that much. So for me personally, I prefer using this area, especially when the market gives me one inducement indicating that the market is strongly bullish towards my direction. Then I can do, most times I do 1 to 2. So if you do 1 to 2 over here, which is what I did, the trade over here, as you can see, this was my Tuesday trade. Now if you also look at what I'm expecting from the market, I already drew this down. This is how. Now the reason I normally draw these things down is that sometimes you might come to the charts and you start seeing different things. You forget. Yeah, it has happened to me a couple of times. When you come to the charts, then you see different moves from what you analyzed in the morning. Then you start flipping your bias. But once you mark it out like this, you already have a clear sense of what to expect, even if it doesn't give you that. But you will need technical information that this is not going to play out anymore. Instead of just having it off and you come back, you see one sharp candle to the upside or downside, you start doing the exactly opposite of what you analyzed in the morning. So, or previously, that is why I normally set them down like this. Now, as you can see over here, what I'm expecting the market to do here, even though the market is still bullish, I can't just take a buy, because there's no structure for me to implement my strategy. So what I'm expecting from the market to do now, since we have this high and this low, I'm expecting the market in the coming hours, few hours from now, to do this, give me a break of structure, as you can see. Then I'm expecting the market to do some inducements, 1 or 2 inducements, then come down to this level, right? Take out the liquidity, tap into a feature or whatever, then I can now get my setup. So you see that it aligns with the strategy I just showed you. Now, like I said, guys, this strategy works for gold, it works for silver, it works for BTC, especially gold, silver, perfectly well for them, all right, on the smaller time frame. So guys, if you love this lesson, if you love this video, make sure to give me a thumbs up, subscribe, and also check our 1000 plus followers on our WhatsApp channel. The link is below this video, guys. Guys, we are all locked in this December. Stay focused, keep chatting, don't give up on trading, guys. There is more to life than just going to work and coming back and repeating the same thing every single day. This skill will give you and I freedom for life. And the good thing about this skill is that you can transfer it to your kids